Hey traders, what's going on? This is Chris from Verlo Trading. Hope you guys are well today. In today's video, we're going to talk about reviewing trades. Some of my thoughts when it comes to trade reviewing and maybe some reviewing platforms and tools that exist out there. So these are ideas that I've come up with over a long enough period of time when it comes to trading. And I've been reviewing my own trading for potentially close to 2 years almost now, trading the NASDAQ. I've tried, some different ways of trading, and I do believe that the way you review your trades, if you review your trades, you need to be reviewing things that are relevant to the decisions you're making. But again, there's a few issues that come into play here, which is the fact that if you're using subjective information or subjective ways of reviewing your trades, maybe you're reviewing your trades in hindsight without knowing it, then how are you ever going to know what the meat and potatoes is when it comes to things you actually need to be adjusting and improving on in your trading? So in this video, I just wanted to maybe give you guys some ideas when it comes to reviewing trades and talk to you about a few of the common pitfalls that traders will experience when it comes to reviewing their trades. Let's get it. So if you enjoyed this content, guys, hit the like button. It helps a lot with the YouTube channel and all that stuff. Does reviewing trades help? I'm pretty mixed on this, I'll be honest with you. And as I've moved more towards being a shorter term trader and trading basically sometimes on a second to second basis, I've realized that reviewing entire trading sessions or reviewing each trade and trying to potentially come up with like the micro nuances that were in play for each trade, in a way, this can actually not be helpful to getting better as a trader. In fact, it can make you basically get a headache and focus on things that are not relevant to your trading. And there's a number of aspects in play here. I'm going to try to go through them one by one, and hopefully this can help some of you out there. This is a bit of a controversial topic, so I don't expect everybody to agree with what I'm going to say in this video. So again, approach it with an open mind, and if you have comments, I'm happy to hear them down below. Remember, we're all trying to get better here as traders, so let's get it. So one thing I can say is that every time I look at a recording of my screen, potentially of today's trading session, the previous day or the previous week, I always learn something new. And often it's very small realizations that I was able to make about something in regards to my layout or something in regards to how I was displaying a piece of data on my screen. I realized that I need to simply get things in a very simple way on my screen, and that's exactly how I have them set up right now. And once you have them that way, when it comes to trading the session and reading the market after it opens, when it opens, you do not spend any time messing around tweaking things in your trading setup anymore. After that time, it's now time for you to trade the market, focus on how it's trading and not focus on tweaking your layout. And I have a bad habit of doing that. So basically, that's one thing that I've been trying to work on and improve. Oftentimes, I look at a recording of myself in the morning and I realize I wasn't even reading the market. I wasn't even paying attention to the market. And I can tell that when I see, for example, that I haven't been recentering my DOMs fast enough, and basically I was distracted. Maybe I'm playing with some windows off to the side. I can hear I'm fidgeting with something else in the background. And again, that's an aspect that I can improve on in my trading. The fact that during the moment that potentially I placed a trade 20 seconds after this, I wasn't even paying attention to how the market was trading. So a little thing like that, it might sound so minuscule and not important, but the fact that I wasn't paying attention to what the market was doing 20 seconds before placing a trade, for me, that's a big thing. Okay, I'm trying to analyze the market on a trade by trade basis. So if I don't know really what the context is around what's happening, then how the heck am I supposed to make a profitable trading decision? Hopefully we're getting somewhere here. I believe that trading is a process of marginal daily improvement. That's why you often hear traders saying the name of the game is to stay in the game. Absolutely, it's true, because every day you're going to learn something new. However, the issue here is that a lot of traders get into the habit of micromanaging things or focusing too much on the micro nuances involved with their trading. So I've heard traders say things like, oh, I lost money trying to short the market near the overnight highs, or I lost money trying to buy the dip when it was near the overnight lows or the low of the day or whatever. This is my opinion now, but I don't believe that when the market is operating on a trade by trade basis, I don't really believe that these bigger levels have that much significance. Okay, they have some significance in regards to the fact that there are some bigger players that may need to be liquidating trades, or there could be some, activity that is happening around these areas. But just because we're at an overnight high or an overnight low, it doesn't mean that you should refrain from trading on one side of the market. And again, a lot of traders are looking at way too much stuff. They have too much conflicting information in their trading. I'm not one to tell you what to do. So guys, take everything I say with a grain of salt. What I was trying to get across is that often traders come up with very subjective conclusions when it comes to their trading. So for example, they'll say, I'm never going to short the market when it's close to the overnight highs because there's a good chance it's going to rip and rally through there. I'll tell you why that doesn't make a lot of sense. Because depending on how the market moved towards this area and depending on how it's currently trading right now, there's a number of things that can indicate to you that taking a short is a perfectly viable trading strategy in the current instant that it's trading, no matter if it's trading close to those overnight highs or not. Again, it could be argued, but again, it depends on your trading strategy, your trading time frame, and all of that. I don't think these kinds of conclusions are relevant to my strategy as a scalper. I don't care if the market is close to the overnight highs or close to the overnight lows. What I can see is how the market is trading right now, how it's trading relative to its correlations, how much volatility is there, how far away do I need to place my orders. All of this stuff is helping me to improve my decision making in the moment. And again, you need to be reviewing the things that are relevant to your own trading methodology. And again, try to refrain from coming up with these conclusions that are subjective, first of all, or that are based on a hindsight analysis, thinking that, oh, I should have done this instead of doing that, because this is just counterproductive. So a lot of traders are not talking about things like, oh, what's the volatility like? How are we trading relative to the correlations? Are the correlations strong today? How much volume is coming in every 15 seconds? Traders are looking at things like, oh, where's the overnight high? Where's the overnight low? Where's the 15-minute candlestick? How's the 1-minute chart looking? Where's the moving average? All these technical tools that are simply derivatives of price. And again, I'm not saying that you need to do any specific thing. If whatever you're doing is working and you're making money, then by all means continue to do that. I'm not telling you that you should do any specific strategy. Actually, none of this is trading advice. It's just my opinion and we're having a discussion. Certain questions that I ask myself that are relevant to my trading when I'm reviewing my session, I focus on things about how the market operates. So I'll ask, what was the volatility like? How much were we moving? How thick is the order book? How much is the S&P futures moving around? Are the S&Ps moving around one tick at a time? Or are they moving around 2 ticks at a time? If the market is thin and more volatile, you trade it differently than if it's only moving around 1 tick. It's also relative to the amount of volume coming in. I focus on where is fair value in the market. What was the ebb and flow of the market during the moment of these trades? Were we seeing more of a momentum-based market or more of a mean reverting market? And certain ways that you can use to determine these types of conditions without being subjective is simply by analyzing the movement taking place in the marketplace. So when you see a market that's going from 20 to 25 to 30 to 40, and then it stops, and then it starts to go down 39 to 37 to 31, that's pretty much, in my opinion, that's a momentum driven market, meaning that it's starting to catch steam in one direction and then it stops. By that time, it's starting to catch steam in the other direction, and then it goes and it goes and it goes and then it stops. Where other days you can see more of a mean reverting market where the market will move and then pause and then move and bounce right off an area and then end up back where it just was. And this is a different type of market than the previous market that I discussed to you. So part of reviewing trades, part of studying the market is about studying the behaviors of the marketplace, but in a way that is not subjective and say, oh, just because the market closed above this area, I decided to buy it. No, it's more about how the market is operating, right? How are the bids and offers moving? How is the price being manipulated up and down? Are we seeing a lot of big traders transacting around one price? Are we seeing a lot of movement without a lot of big traders doing business, for example? There's a lot of questions you can ask in regards to how the market is trading. So other question I ask is, are the correlations tighter? Are they slightly off? Is the NASDAQ moving in tandem with the S&P futures, or are they moving contrary to one another? So these things are relative to my trading method. So again, you want to be focusing on reviewing the aspects that are relative to your trading method. Now, here's one of the tricky things when it comes to reviewing trades. So a lot of traders, they review their trades in a very obsessive way. And like I previously discussed to you, they're trying to focus too much on the micro nuances of why their trade worked or why it didn't. And they're forgetting to account for things like luck. For example, let's say the market is moving up and I'm looking to basically stay on the buy side of this market. Now, I place an order to buy at the price. I get filled very quickly. I'm in a profit for a few seconds. And then all of a sudden we see a very big trader trade on the sell side of the market and turns my perfectly good trade, because it was a perfectly good entry, I categorize that as a perfectly good entry. All of a sudden, it turned into a bad trade simply because we had a big trader come in and drop a block on the market. Some traders are going to start to look at micro nuances. They're going to say, oh, were we into a specific area? Or what else can I look at that's going to help me to stay away from that in the future? When in reality, you're just not simply realizing that the fact that the big trader came in at that moment is just random. That's just randomness in the market. You just got unlucky. Okay, if you look at your trade objectively and you see that I got filled on the order in exactly the way that I needed to get filled, that tells me that this was a good order placement, then you know that this trade was perfectly fine. It just so happened that you didn't move your stop up quick enough, and then all of a sudden the big trader came in and knocked you out of the trade, and now potentially you're down on the trade 5 points or whatever. It was bad luck. So guys, don't forget about luck when it comes to reviewing trades. You're playing a game of probabilities, and luck is certainly a big aspect here. I was talking to my friend earlier. He said something funny. He said, dude, if you want to make money trading, you just need to get luckier. So guys, this is why I believe reviewing trades can only take you so far. And I'm going to talk to you about a few things now as to why I believe this. So in reality, yesterday's market has nothing to do with tomorrow's market. When it really comes down to the core aspects of how a market operates, how the market's trading today has nothing to do with how it traded yesterday. It has nothing to do with how it's going to trade tomorrow, because the sentiment can change overnight. The participants in the market are different today than they were yesterday. The movement in the marketplace, the volatility in the marketplace is different because of all of the different aspects that come together to determine how this market is going to be trading today. So if you're reviewing your trades from yesterday and you're saying, oh, I placed my orders too far away, or I placed them too close, you show up tomorrow and then you start using that information in the back of your head to place your orders, you're probably not going to experience success, because what you're doing in the back of your mind is you're trading yesterday's market instead of trading today's market. You're not adapting to the current conditions enough. And this, I believe, is where a lot of traders mess up. You can excessively review trades, but there's a limit to how much you're going to be able to improve. So again, you show up tomorrow, the volatility is totally different. Everything changes. Now the market is moving differently, and everything you did yesterday is not working today because the market's trading differently. It's a totally different marketplace. It's the same ticker symbol, but the sentiment is different. It's moving differently. You have no idea what's going on. That's where the skill of adapting comes in. If you're trading the market in real time on a scalping time frame, maybe even position trading, some days averaging into trades works. Other days, you're going to lose your whole account on those days. Some days scalping for 5-point rotations works. Other days the market's only giving you 3, and then you're never getting your targets hit, for example. And if you're not there to adapt to what's happening, then you're just going to lose your money. You're just going to be giving your money away to traders who are adapting to the market day by day. What I can say is stay away from excessively reviewing your trading and try to focus more on that marginal improvement. Small adjustments that you can make when it comes to your ability to adapt to current market conditions will go a long way in your trading. Another thing is looking at your trading stats. So there's journaling tools out there, right? You can plug in your trades to the journal and they'll tell you, on average, you lose money around 11 o'clock. On average, this and that. Or on average, when the trade goes against you 20, it tends to go against you 30. On average, your profits are this much. On average, that much. But if you're not understanding the critical aspects about how the market was operating when you took each one of those trades, then reviewing that data could be argued as being completely useless, because you took one trade and you got stopped out. Maybe you judged value wrong in the market, or maybe you just got unlucky. If you forgot to write down what happened there, did you get unlucky? Or maybe you didn't even realize that you got unlucky and everything about that trade was perfectly fine. If you are not able to acknowledge these things about your trading, then you're not going to be able to improve your trading. This is part of what makes trading very hard. So again, there's certain aspects of reviewing trades that can help you. And I believe that a large part of it is going to be making very small adjustments to your trading. Like for example, let's say you take 20 trades in a day and you see that on average, if you could have just taken 1 point profits instead of 1 point losses when it comes to scratching trades on the NASDAQ, for example, that would have made the difference between you being a break-even trader and being a profitable trader. Small things like this could be used to make very important adjustments in your trading. But again, you need to make sure that you understand the conditions that were present when you were taking those trades, and understand that today you're placing your orders 1 tick away from the price. If you do that tomorrow, you're most likely going to get run over. Again, it depends on what's happening right now. So Please, guys, do not trade yesterday's market today. Trade today's market right now. Stay away from overthinking your trades and trying to, micromanage everything. I believe that there's really a big limit when it comes to how much info you can actually gain from reviewing your trades. Focus on that marginal, slow improvement, and don't be in a rush to get better at trading, guys, because remember, this is probably the hardest game in the world. So, guys, if you enjoyed this video, smash like. If you want to have more discussion, comment section below, and I'll catch you soon. Take care.